Hey there. Now you've worked really hard, saved up all your life, and now retirement is finally here. It's time to relax, enjoy life, and you're planning on making the most of the years ahead. But what if I told you there's one simple mistake that could put your entire retirement at risk? And this is something that catches people off guard all the time. Hey everyone, I'm Mike Upland, early retiree at age 55. Now picture this. You retire with a solid $1 million in savings, and you've planned how much you're going to withdraw per year. Everything seems great until the stock market takes a nosedive in your very first year of retirement. Suddenly that $1 million turns into 700,000 and now you're withdrawing from a shrinking pot. Even if the market eventually bounces back, you're now afraid your portfolio might never fully recover. And the worst part is you might not even realize it's happening until it's too late. Now, you followed all the traditional retirement advice. You've saved a ton of money, you've diversified, you're withdrawing responsibly, but you still are running out of cash far earlier than expected. And that's why I want to talk to you about something most financial planners and retirement calculators just don't emphasize enough. It's sequence of returns risk. And honestly, this has been on my mind a lot because of what's happening in the markets right now. As you know, March of 25, we're seeing a lot of uncertainty. The new tariffs on Canada, Mexico, and China are quite frankly shaking up the economy. We've seen consumer confidence falling, and that pesky old inflation is creeping back up. If you're nearing retirement or you've already retired like me, this is a kind of volatility that can completely derail your financial plan. And I know for me, it's certainly stomach churning to see your nest egg lose value. And that's exactly why understanding when you withdraw money from your investments, it's just as important as how much you withdraw. But I don't want you to worry too much. I'm not just going to leave you with bad news. I want to walk you through exactly how to avoid this mistake so that your retirement savings can last as long as you do. Now, most people focus on hitting their magic number. They focus on, I've got to hit $1 million, $2 million or more. And the idea is that once you hit that number, well, you're set for life. But the thing is, it's not just about how much you have, it's about when and how you take it out. If the market's booming in your first few years of retirement, you might be fine. But if you start withdrawing money when the market is down, you could be in trouble, even if you saved a lot. It's kind of like hiking up a mountain. You get to the top and the view is great, but sometimes when you're coming back down, accidents can happen. Retirement can work the same way. You're managing your money after you retire is really just as important as building it up in the first place. And think about it. How many times have you heard stories or watched, an episode on television about somebody retiring only to find out a few years later that they are struggling financially and have to take a job in their late 70s? Maybe they thought they had more than enough, but they didn't realize that timing plays a massive role in how long their money would last. And that's what's so scary about today's stock market volatility. Some people might be retiring right now thinking they have plenty. But if they start withdrawing just as inflation pushes prices up and markets fall further, their nest egg might not last as long as they had planned. Have you thought about how your retirement could be affected by the timing of a market downturn? Drop a comment below, and I'd really love to hear your thoughts. Now, again, this is all called sequence of returns risk. Even though the stock market trends upward over time, and that's why we invest in it, the order in which you experience gains and losses matters more than you think, especially in the early years of retirement. It's because if you start withdrawing money during a downturn, you're selling assets at lower prices. This means you have less money left to grow when the market does recover. And if this happens in the first 5 years of retirement, it can seriously shorten how long your savings last. And right now, with the economy in flux, this is not a theoretical risk. It's happening. With interest rates fluctuating, rising inflation, and economic uncertainty, the market could see significant swings in the coming years. And we're even hearing that now from the experts. If you're withdrawing from your investments while they're taking a hit, you could find yourself in trouble faster than you'd expect. So here's an example from the market downturn in 2008. If at that time you retired with $1 million, the market crash then would have cut your savings to around $600,000 within months. If you were withdrawing, let's say, around 4% a year, which is a standard kind of FIRE rule, you'd now be taking a much larger percentage from what's left, draining your savings even faster. And let's say the market today does something similar, which is very possible given the uncertainty we're seeing. Would you be prepared to weather a downturn in those first few years of your retirement? And that's exactly why we need to talk about solutions. So here are 5 strategies I want to give you to avoid this risk. The first is to protect yourself from sequence of returns risk by having a cash buffer. Have money set aside in cash or other conservative assets to cover your living expenses during those market downturns. Now, a lot of times you'll hear a common rule of thumb is to keep 1 to 3 years worth of expenses in cash. However, that may not always be enough. And it's because bear markets can last 1 to 2 years and full recoveries can take 3 to 5 years or longer. If you're withdrawing from investments while they're down, you risk locking in losses and running out of money faster. A better strategy and more conservative approach is to keep 3 to 5 years worth of cash in safe assets, such as high yield savings accounts or money market funds, or use a CD ladder. And this gives your portfolio time to recover before you need to start selling investments. And the exact amount of money that you need really is going to depend on your risk tolerance, your spending needs, and other income sources you may have, like rental income or if you're on Social Security. This is critical during uncertain times like today. With that pesky inflation creeping up and markets shaky, having cash set aside means you're not selling stocks at a loss if things take a turn for the worse. Second, be flexible in your withdrawal strategy. Adjust your spending based upon market conditions. For example, if you were planning to withdraw around 4%, but the market dropped significantly, cutting back to 3% or pausing just major expenses could make all the difference in helping to keep your portfolio intact. Third, and you've probably heard of this, follow a bucket strategy. That means separating funds into short-term, mid-term, and long-term investments. This helps ensure that you're not relying too much on stocks when markets are volatile. Having a balance of short-term cash, medium-term funds like bonds, and long-term growth assets can smooth out your retirement income. Fourth, delay Social Security if possible. With inflation concerns, locking in a higher Social Security check later on could help cover rising living costs without putting pressure on your investments. Fifth, consider part-time work or side income to reduce your withdrawals during those downturns. Given the uncertainty in today's market, just having even a small extra income stream could be a lifesaver in keeping your investments intact during rough patches. So now you know, it's not just about how much you save, but how and when you withdraw it. And with everything going on right now in 2025, with the tariffs, the inflation, the market swings, this is something you just have to take seriously. If you're thinking about retiring, or even if you've already retired, this really is the time to review your strategy. If this helped you, please hit the like button, subscribe. I really appreciate it to help grow this very small channel, and I appreciate your support. And drop a comment below. It just takes a few minutes of your time. And I'd really love to know what your take on the economy is right now. How worried are you about how it will impact your retirement or your retirement plans? And let me know in the comments. I'd love to hear from you. Until next time, take care and make the most of today.